Okay, so SMIF is pleased to present our option strategy to the Board of Trustees. This is a more in-depth look at our strategy that we presented back in January. Since that presentation, we have assembled an options team, which consists of me, John Goldzer, Christian Kritas, John Kipley, Benjamin Visca, Chris Curlin, and Drew Liguori. And each of these team members have completed a certificate of completion with Bloomberg Market Concepts for options trading strategy, which is a course that goes through the basics of options trading, the terms involved, and goes over multiple different strategies.
Hi, I'm Christian, and I'll be giving an overview of the covered call strategy. So selling covered calls is an option strategy that generates income from premiums and provides some protection against downside risk of owning a security. It involves selling call option contracts, which give the contract buyer the right to purchase 100 shares of the underlying stock at a given time and price if the stock value reaches the contract's strike price. Using the covered call strategy would give SMIF the ability to generate income on securities that we already own by selling short-term out-of-the-money call option contracts and then collecting the premium from those sales. This strategy would reduce our exposure to market volatility and protect against downside risk as long as the stock value does not fall below the collected premium. Implementing this strategy will create opportunities to learn about financial derivatives consistent with building the finance major here at Geneseo. And it necessitates the inclusion of exit strategies for SMIF positions, which will limit the losses that we have and improve the ability of SMIF members to analyze companies. Thank you.
So with covered calls, there obviously are some risks involved. So we have listed out our risks here, as well as our strategies to hedge against these risks. First off, with covered calls, they do limit profits in some scenarios. So in order to hedge this, our exit strategies will guide our decisions on strike prices, and our price target will be updated on a regular basis to ensure that strike prices provide sufficient returns to meet the fund's thesis. Another risk is that SMIF may lose shares in a security if an option is called upon. So in order to hedge this, the options team will monitor all open contracts closely, and SMIF will buy back into positions that are still consistent with the thesis. Last, if there is not enough trading volume, it may be hard to exit the strategy and close the trade out early. In our options trading policy, which is linked below, specifies that high trading volume as criteria for trading consideration. So these are our risks. And again, we've listed how we plan and strategize to hedge against these risks to make sure we can maximize our profit.
So here are a few of our rules that we've established for options trading policy. We also have an extensive full options policy document that will be also shared with you in the email. So as a prerequisite to joining the options group members will be Bloomberg Market Concepts Equity Option Certified, like I mentioned before. This is a course that provides the fundamentals of options trading and walks through single and double leg strategies, along with an extensive piece on covered call options. So our number one rule with actually trading the contracts is that we will never be naked in a call or put position. We're always going to own the underlying security, which will protect us, and that's our main basic rule. And every trade that we make, at least for this first semester, will be reviewed by SMIF advisors, Professor Boyd and Professor Chinmay. Strike dates that we select will be between 2 weeks and 2 months. Strike prices will be consistent with the identified exit prices and with the observed historical volatility of the stock. And only contracts with significant open interest will be traded to ensure we always have a buyer for our contracts. We'll utilize several tools like multiple Excel models, the TD Ameritrade options chain, and the Bloomberg options monitor function in order to select our contracts. And like I said, we have a more in-depth policy that's written out in a document attached.
Yeah, so looking into how we will use the Greeks. So as you may know, there's a few things that influence options, such as volatility, time to expiration, and increase or decrease of the underlying price. To help manage those few things, we can use the Greeks. So they represent different dimensions of risk that go into options. It's delta, gamma, theta, vega, and rho. They help to look at how different factors such as price changes, interest rate changes, volatility, and time affect the price of an option contract. So mainly we'll be looking into delta and theta in SMIF. So delta is how much we can expect an option price to increase or decrease based on a change of $1 for the underlying security. We use delta to understand how much the option would be worth if the underlying stock increased or decreased. In addition, we'll be using theta, which is the time decay of an option. So that meaning an option loses value as it gets closer to maturity date. Gamma, vega, and rho, SMIF will not be using to start. We'll mainly be just focusing on delta.
All right, so this is a decision matrix on covered calls. This is kind of covering how we're going to sustain our model and how we're going to continue to continually renew these contracts and continue generating profits. So here on the left side, you have two options. Either the contract expires or the contract is called upon. And if the contract expires and it has the price of the underlying security hasn't reached the exit price that SMIF has identified and targeted, we will sell a new contract at a newly identified strike price and date. And now, if it has reached the target exit price that SMIF has identified, we will not be selling a new contract, and we'll decide then what to do with the underlying security. But we'll no longer be selling options contracts on that security. Now, if the contract is called upon, so we forfeit our shares, we are forced to sell them, and it hasn't reached our target exit price, we will most likely be purchasing shares to maintain our position in the portfolio and our weight in the portfolio. But if it has reached the target exit price and we're happy to sell it, and we're happy with the gain we've made, we will not be purchasing additional shares. And all decisions will be made with consultation from faculty advisors and related SMIF groups. So a lot of these things before executing, we would go back and consult with the accounting team, or we'd consult with the with the analysts to determine if we do really want to buy these shares or continue selling.
So what I'm going to do now is go through a possible covered call strategy we can enter with the stock we own called Waste Management. And first, I have pulled up the changes in price within 2 weeks for the past year of this stock. So for all of these stocks, you can look up all of the price history, whatever we need. And basically what this is a value at risk model, which takes the principal that we're going to be trading with, the mean, standard deviation, and a set confidence level to determine what's the max this stock could increase within 2 weeks based on the past data. So what we do is we enter the information. So with Waste Management, it was 157 with 100 shares at a 95% confidence level. The max increase per share in 2 weeks would be about $7 or 4.6%. This gives us a target price of about 165 for our call contracts that we want to sell. So then we go on the model right here, enter all the information for that call. Should be a strike price of 165, a premium of about 135 per share. Price it was trading at today was 157 with 100 shares and one contract. We can see that our max profit would be about at this point when the shares reach 165. So if we look at the graph here, you could see as the price goes up, our contract total profit will vary until it reaches that one price. And essentially it'll always be this max profit because 100 shares will cancel out. After that, we can move to our multiple strategy model, where we can enter all of this information for 5 different strategies and so on, and enter in the date, which is now 3/8, and we can see how many days until expiration. We can compare different profitabilities between different options and compare different lengths of option contracts. Like right here, we have some that are 2 weeks out. Right here, we have some that are a month out. Basically, we could come together as a group and decide which is going to be best for us. Right here, strategy 2 is highlighted, which is the ones I just showed you guys, and it's graphed out right here on the display. So we could see max profit. If the option is called, we can make 6% from this covered call strategy with waste management. That's all I got. Thank you.
Better?
Yeah,
As a team, we'd like to thank you for your continued
so you
support.
still, we lost you real fast. What are you doing that sometimes we hear you well?
I don't know, it might be, I sometimes have to hold my, is this better?
Yes,
Okay. As a team, we'd like to thank you for your continued support. Again, attached below, you will find our detailed options policy statement, hyperlink to the right. We would be happy to answer any questions you guys have for us, and we look forward to trading options and delivering solid returns for the foundation in the near future. Thank you.
good.
Okay.
Okay. Stop recording.